Welcome to the next series of videos on the capital asset pricing model. In the previous presentations, we focused on estimation of beta. In this presentation, we're going to focus on estimation of other inputs into the model, namely the expected market return and the risk-free rate. And the difference between those two things is the market risk premium. Now, it's important that you understand the difference between the expected market return, which is often written as RM in an equation, and the market risk premium, which is often written as MRP, or RM minus RF for the risk-free rate. Unfortunately, it's a large source of estimation error amongst students when they're performing calculations, in that they seem to use the market risk premium and the expected market return interchangeably. The market risk premium is the return we expect on the market portfolio of all risky assets above the risk-free rate of interest. Now, to remind you, in theory, the whole market is just not a stock market index. The whole market is not the S&P 500 or the S&P 1500. The whole market is the universe of all assets. But because it's very hard to measure the returns of all assets, like art and some thinly traded bonds and some thinly traded real estate, all of these other assets, and because stocks are readily observable in terms of share prices, we often use a proxy for the whole market being a stock market index. So let's start with an easy one, which is the risk-free rate of interest. As earlier, I'm going to toggle back and forth between some PowerPoint presentations and some websites and some Excel. The risk-free rate of interest is a theoretical concept of a rate at which everyone can borrow and lend. In practice, though, we have to turn to a government bond yield. So the only question becomes, what term to maturity do we want for a government bond yield proxy for the risk-free rate of interest? The most common proxy that I use and that lots of people use in practice, probably the most common proxy, is the yield to maturity on 10-year government bonds. But we can look at yield to maturity on longer term government bonds, like 20 or 30 years, provided those bonds are actively traded. They're liquid, and that the measurement of the risk-free rate is consistent with the measurement of the market risk premium. So if we're going to use some historical data to measure the market risk premium, which is one technique which we'll go through in this presentation, and we're comparing market returns minus some government bond yield proxy, we have to ensure that our definition of the market risk premium is consistent with whatever we use today as our proxy for the risk-free rate of interest. So one thing that we can do is go to the Federal Reserve website and observe what is the yield to maturity on 10-year government bonds at some point in time, but we want to convert that to an effective annual rate, because that's typically quoted as an annual percentage rate. Now, I prepared these slides a year ago, and so I'm going to update this data for current information in terms of the risk-free rate. So I'm going to go to the same website that you see here. And if I go to that website, what we're going to see is that interest rates are much lower. On the row, you can see each date. If I scroll down a bit to Treasury constant maturities on that website, you will see yield to maturity on 10-year government bonds, and using the most recent data available, that number is 1.12%. If we went to the data tab, we could look at some historical data on that yield to maturity, but for illustrative purposes, let's do this calculation. So on March 19, the US Federal Reserve estimates that a 10-year government bond would offer a yield to maturity of 1.12%, expressed as an annual percentage rate. That doesn't necessarily mean that a bond maturing in exactly 10 years after March 19, 2020 existed. It means that there is some bonds out there which might have a term to maturity of close to 10 years, maybe 9.5 years or 10.25 years, and someone at the Federal Reserve or a data provider has done an estimate and said, here's the yield to maturity for a 9.5 year maturity bond, here's the yield to maturity on a 10.25 year maturity bond. If I was to estimate what the yield to maturity would be for a bond maturing in exactly 10 years, what would be my best estimate based upon bonds which have a yield to maturity close to 10 years. So there's an estimation exercise going on here. So these are just approximations of the yield to maturity on a 10-year government bond. To convert that 1.12% to an effective annual rate, as per usual, we want to divide that by 2 because there's going to be 2 compounding periods per year, assuming semi-annual coupons. Add 1 and then take that to the power of 2 minus 1. So we're going to use our equation that says that the effective annual rate is equal to 1 plus a periodic rate to the power of the number of periods in a year minus 1. Now in this circumstance, the periodic rate is going to be half of the annual percentage rate. So in this circumstance, the periodic rate is going to be annual percentage rate divided by the number of periods in a year, which is going to be 1.12% divided by 2, which is going to be 0.56%. So applying that to our computations, if I had an annual percentage rate of 1.12% and I had periods per year of 2, then the periodic rate is going to be equal to 1.12% divided by 2, and then the effective annual rate is going to be equal to 1 plus the periodic rate of 0.56% to the power of 2 minus 1, and that's 1.123%. So in this circumstance, because the interest rates are so low, the effective annual rate is very close to the annual percentage rate. It's just a little bit higher by 0.003% because of that half-yearly compounding. So if we were doing this computation today, our estimate of the risk-free rate would be 1.123% based upon 10-year government bonds. The reason 10-year government bonds are so commonly used is for comparability over time and across countries, because most countries in developed markets are issuing bonds of at least 10 years to maturity, but not every country is going to be issuing 20 or 30-year government debt. There's also a very long time series of these computations for 10-year government debt. So that's our first computation. And if I refer to the after-class version of this spreadsheet, I would say that based upon computations from approximately 1 year ago, when I prepared the presentation, the risk-free rate was 2.45%. Using current information, we've just done a computation that the effective annual rate is 1.123%. That's the current figure. Well, that was easy. Let's talk about the market risk premium. This gets a bit more complex because we can't readily observe the market risk premium. The first thing to understand about the market risk premium is that this is an expectation. We're trying to guess what the expected market return is relative to the risk-free rate. And one way we can think about that estimate is to look backwards from historical data, but it's not the only way. So, for example, there are 4 forward-looking indicators which I often use to estimate or form a view as to the market risk premium. I use these estimates in practice, and in fact I've just submitted estimates of the market risk premium for someone who is very interested in that figure with an estimate based upon these specific indicators. First of all, there is the earnings yield. The earnings yield is the inverse of the price-earnings ratio. In the numerator, we're going to have a projection of earnings per share, and in the denominator, we're going to have a price. Now, this is going to be an aggregation of the earnings per share for all the listed companies in our definition of the market relative to their price. The earnings yield, we're then going to take minus our definition of the risk-free rate. The earnings per share projection could be for whatever time period we have analyst forecasts available. There's going to be a large number of analyst forecasts available with a 1-year forecast horizon, but you can use forecast horizons of 2 and 3 years. In fact, I've just used an average of analyst forecasts over 3 years, again to mitigate estimation error. In fact, the 3-year forecast is going to be a more reliable estimate of earnings yield, because in any 1 year, even though it's a forecast, you can get lots of noise. In the current market conditions, where the S&P 500, as of the date of this presentation, is down 32% from its peak of just 30 calendar days ago, that is telling me that short-term corporate earnings are going to be significantly negatively affected by the current slowdown in the economy. That means that as a projection of earnings yield, that number is going to be unusually low. But we should see a more normal estimate of earnings yield 2 and 3 years ahead, which might be a more reasonable proxy for how much the market risk premium is today. We should also be seeing the market risk premium go up right now because of volatility in the market, but we're seeing earnings fall, which is going to be the main reason why share prices are down so far. The second forward-looking indicator that I like to use is the implied volatility from options prices. Now, you haven't done any pricing of options yet, but an option contract is where the buyer of that contract has the option to proceed with a trade in the future. So, for example, if I buy a call option on Domino's stock, that means I've got the option to buy Domino's stock at a pre-specified price written in that call option contract. And that pre-specified price is called the exercise price, also called the strike price. If I buy a put option, it means I've got the option to sell an underlying asset like a Domino's stock for the pre-specified exercise price. One important variable which is factored into the price of call and put options is how volatile stock prices are expected to be. The more volatility in stock prices, the more valuable is an option to buy or sell that stock. Because if you're the holder of this contract, it's your choice as to whether you go ahead with buying the stock under a call option or selling the stock under a put option. The more volatility in the market, the more you will pay for the option to proceed with the trade, because there's more chance that you realise upside potential, but your downside is still zero. You can still walk away. The more there should be a relationship between volatility in the market and what returns investors want before they're prepared to invest in the market. So in the current market conditions, where volatility has suddenly increased, that would be correlated with an increase in what return investors want before they're prepared to buy that market. Right now, only investors who are prepared to accept lots of volatility will be buying, and that should be factored into the returns they should expect given the risk of the investment. So we should see a positive relationship between earnings yield relative to the risk-free rate and the implied volatility from options prices and the market risk premium. The third forward-looking indicator is the term spread, and that is the gap between the yield on long-term government bonds and the yield on short-term government bonds. So, for example, you could take the difference between the yield on 10-year government bonds and the yield on 2-year government bonds as a proxy for the term spread. The idea is that part of the reason why the yield to maturity on average for long-dated government debt is higher than the yield to maturity on short-dated government debt is because of interest rate risk. There is more risk exposure if you buy 10-year government debt. But that interest rate risk exposure is also likely to be correlated with risk exposure in the aggregate market. So when investors want more compensation for exposure to interest rate risk in government bonds, they probably want more compensation for bearing overall risk exposure. And that means we should observe a positive association between the term spread and the market risk premium. Finally, a forward-looking indicator of the market risk premium is corporate bond spreads. That is the gap between the yields on corporate bonds and government bonds. And a typical proxy for the yield on corporate bonds is the yield on BBB rated bonds from a rating agency, because BBB is the most prevalent credit rating. We should expect when investors want higher returns for taking on credit risk, they probably also want higher returns for bearing overall market risk. So in aggregate, we should expect the market risk premium to be high when these four forward-looking indicators are also high relative to what we've observed in the past for those forward-looking indicators. Earnings yield minus the risk-free rate, implied volatility from options prices, the term spread, and corporate bond spreads. Now, it's possible to estimate the expected market return, just like we estimated the yield to maturity on bonds, by projecting dividends for the entire life of the companies listed in the market, and then computing the discount rate that sets the present value of dividends equal to the market price. So you recall when we did bond pricing, we said if I have a series of projected coupon payments and a projection of the face value of the bond at maturity, and I observe the price of the bond, I can say, well, the yield to maturity in that bond is X%, as the discount rate that sets the present value of the coupon payments and the face value equal to the price. Well, I could estimate a discount rate for the whole market, that's the expected market return, by projecting all the dividends the market is projected to generate, discounting those back to present value, and find the discount rate that sets the present value of those dividends equal to the price of the market, aggregating up all the companies in the market. Now that's a useful computation to do, but there's lots of estimation error, because we only have analyst forecasts of dividends for a reasonably short horizon, 1, 2 or 3 years, and we have to make some assumptions about how those dividends might grow at some period outside that initial forecast window. And so we're not going to go into that in any more detail. It's something we consider in more advanced classes, but be aware that's one way of thinking about estimating market returns. So in summary, we've got a couple of ways of looking at forward-looking indicators for the market return and the market risk premium, that is the premium compared to government bond yields. We've got the forward-looking indicators that you can see on the screen highlighted in red: earnings yield minus risk-free rate, implied volatility, the term spread and corporate bond spreads. And we can also estimate the market return by doing a projection of dividends, assuming a growth rate of those dividends, and then discounting back to present value and finding the discount rate that says the present value of dividends equal to the market price. You won't be expected to do those computations, but you should be aware that they exist. If I don't tell you that they exist, it's possible you will form the idea that the only way we can estimate the market risk premium is to look at historical data, and that's not true. But now we are going to look at historical data, and I'm going to consider estimates of the market risk premium by analysing the historical data in 2 ways. The first thing that we're going to do is look at the average market returns less government bond yields. And secondly, we're going to look at average real market returns converted to expected nominal returns, and then take away today's risk-free rate. And we're going to do that as a practical exercise in Excel, which I will walk you through. Here are the specific steps that we're going to take. In the Data tab, we're going to compute the difference between the nominal market returns and government bond yields at the start of each year. And we're going to take an average of that series. That's going to be the first estimate of the market risk premium on average. The second approach we're going to take is to, for each year, we're going to make an estimate of the real market return, and we are going to take an average of those real returns, and then we are going to incorporate today's estimate of inflation to get an estimate of nominal market returns and subtract today's risk-free rate. Okay, so let's do the individual steps in Excel. I'm going to go to the before class version of our spreadsheet. We're going to use the cells in green as our computations. In columns B, C, and D, I've got some raw data. Column B is the S&P 500 Total Returns Index. It's not returns, it's the index. So we're going to have to compute percentage returns on that index. The This column C is the consumer price index. It's not inflation rates and percentages, it's an index. So it's showing you an estimate of the relative change of a basket of goods in terms of prices. So you take a basket of goods that would have cost $82 in 1980, it's going to cost $91 in 1981. What you have here in column D is yields on 10-year government bonds at the start of the year, expressed as an annual percentage rate. Let's do our computations. We're going to take, first of all, the nominal market return, and my formula there is B3 divided by B2 minus 1. So I've done a computation of the percentage change in the S&P 500 total returns index. Now, a data provider has already done an estimate of a total returns index that has incorporated both capital gains and dividends. So this tells me that, I'll go to more recent data for context, tells me that in the year ending March 2019, the nominal market return was 10.3% in that year. The next thing I'm going to do is compute the yield on 10-year government bonds at the start of the year, because what we're doing is computing returns, say, ending 2019, relative to what we could have earned if we had put our money in government bonds at the start of the year. So all I'm going to do is convert the annual percentage rate estimate of the government bond yield into an effective annual rate. So I'm going to use our equation of equals 1 plus the annual percentage rate divided by 2, because there are 2 compounding periods, to the power of 2 minus 1, and that yield is 13.49% in 1981. And if I double click on this little cross, that'll transfer all the data down below. The inflation rate is the percentage change in the consumer price index for the year. So I'm going to take C3 divided by C2 minus 1, and that tells me that in the year ending March 1981, the inflation rate was 10%. That's rates you're unfamiliar with. If we look at more recent data, we've got figures of around about 2% or 1%. You can see that if I draw a chart. Inflation rate has come down quite significantly in those early years because the Federal Reserve began using monetary policy, that is trying to adjust interest rates, to try to maintain inflation within a lower band. The Fed has a target inflation rate of about 2%, even though if you go to very recent periods, the average inflation rate is even lower than 2%. Now let's do the difference between nominal market returns and the yield on the government bonds. So that is going to be the gap between cell E3 and EF. So that tells me that in the year ending March 1981, the market return was 8.12% higher than the yield on 10-year government bonds at the start of the year. Usually looking at more recent data, in March 2019, for the 12-month period, the market return was 7.45% above the yield on government bonds. So what I'm going to do, I'm going to pause there a moment. That's going to give me, on average, one estimate of the market risk premium, because I've worked out, on average, every single year, market returns minus the risk-free rate. On the market risk premium tab, I can then take an average. So if I go to that number, go to that tab, I can look at approach 1, and approach 1 is going to be the average of stock and market returns less government bond yields at the start of the year. So I'm going to take an average of what you can see in the data tab from column H, cell H3 to H41, and that average is 6.58%. That tells me on average, using all the historical data that I have in this exercise, the market returns were 6.5% above government bond yields. Now, when we did this analysis, or when I did this analysis a year ago, I had an estimate of the risk-free rate of 2.44%. All right, so I'm going to put that in my table. 2.44% was my estimate of the government bond yield expressed as an annual percentage rate. If I wanted to convert that to an effective annual rate, I'm going to take 1 plus half of that annual percentage rate to the power of 2 minus 1. That's 2.45%. I can use that same risk-free rate estimate above And if I add in the market risk premium to the risk-free rate, that will tell me that based upon this estimate of historical data, I would expect the market to earn a return of 9.04%. Now, that doesn't incorporate any contemporaneous information. It doesn't tell me anything about what's going on right now in the market or when I did these numbers a year ago. It's simply a baseline, and I might shift that baseline based upon information that I'm factoring in today, like the corporate bond yields or the corporate bond spread, or the earnings yield minus risk-free rate, or the implied volatility, or the term spread, which we talked about earlier. The inflation that I'm going to factor in is going to be from the Federal Reserve website as well. The inflation rate I can factor in is going to be the difference between inflation-protected securities and the regular 10-year government bond yields. And the data that I compiled a year ago had that gap be 0.54%. And that tells me that the inflation estimate in the market was actually very low, because inflation has come down even below the Fed's target. If I convert that to an effective annual rate using the same equation, apologies, that was the yield to maturity on the inflation protected securities. And the inflation rate is the gap between the regular government bond yields and the inflation protected government securities yield. So in short, if you had bought regular government bonds with a maturity of 10 years, your prospective return would have been 2.45%. But if you decided, I want to hedge my risk against inflation, I want to buy these inflation protected securities, you would be expecting a return of about 0.54% on those securities. And that gap between the regular government bond yield and the yield on inflation protected securities, that gap of 1.91% is a market-based estimate of future inflation. So I'm going to use that estimate as my expected inflation rate, and then I can make an estimate of what I think real returns are going to be in the market. I can take my estimate of 1 plus my nominal returns estimate divided by 1 plus my estimate of inflation minus 1, using the same equation we've used many times for estimating a real rate of return. And this tells me that my expected market return in real terms is 6.99%. Well, that's not the only way that we can estimate the expected market return. There's a different time series we can estimate here. What we're going to do is look at historical real returns in the marketplace, and this is going to be estimation 2. So we're going to go to our data tab, and in the data tab I'm going to compute the real market return in each year. To do that, I'm going to use the same equation we presented just a minute ago, which is going to be the real market return each year is 1 plus the nominal market return from cell E3 divided by 1 plus the inflation rate in that year minus 1. And that real market return is going to be in column I. So I could take an average of that real market return and I can put that into cell B20 of my results tab. So if I take an average of the real market return across all of those years, that average is 9.68%. Now, it's important that you understand these two estimation techniques because they give you different answers. When we did the first estimation technique, we were making an assumption that the premium of market returns relative to the risk-free rate is going to be the same in the future as it was in the past on average. But now we're going to make a different assumption. We're going to make an assumption that the real stock market returns in the future is going to be the same as it was in the past on average. And they give you different answers. Under estimation technique 1, the projected real return in the future is going to be 6.99%. In the past, the real return on average was 9.68% in this data set. So estimation technique 1 gives you a lower estimate of prospective real market returns going forward. And that's because government bond yields are much lower than they were today than they were in the past. But we don't necessarily know which of these assumptions is correct. Should we assume that the risk premium is going to be constant in the future, equal to its historical average? Or should we assume that real market returns are going to be constant compared to their historical average? We actually don't know which of those assumptions is true, and that's why I like using both of these techniques to ultimately come up with an answer for the market risk premium. So under estimation technique 2, I start with my estimate of real market returns, and then I work backwards. I incorporate expected inflation of 1.91%, and then I come up with an estimate of the nominal market return by saying 1 plus the real market return multiplied by 1 plus the inflation rate minus 1 gives me an estimate of the future market returns in nominal terms. I'm just going to switch over and check whether that computation is consistent with my results. It is. The risk-free rate is still 2.45% in the context of when we did this data. And then the market risk premium using estimation technique 2 is 11.78% minus the risk-free rate, or 9.33%. So now I've got two estimates of the market risk premium, and I'll shade those in pink. If I take an estimate of the historical average market returns minus government bond yields, that would give me 6.58%. But if I start with an average of historical real returns, factor in today's inflation rate estimate, and then take away the risk-free rate, I get an estimate of the market risk premium of 9.33%. I don't know which of those assumptions is true, so I'm going to take an average of the market risk premium from both assumptions. I'm going to take my risk-free rate of 2.45%. I'm going to take an average of the market risk premium from both of these estimation techniques. I'm going to add the risk-free rate plus the market risk premium together to give me an estimate of the expected market return in nominal returns of 10.4%. I'm going to incorporate expected inflation of 1.9%, and then I'm going to compute an expected real market return of 8.34%. So looking at our results, here is my conclusion. Based upon these two estimation techniques, I could have a market risk premium which is either 6.58% or 9.33%, or an average of 7.95%. I don't know which of those techniques is the best technique. There's uncertainty here, so I would use an average between those two techniques as a baseline. But that's not where I would end the analysis. In a real situation, I would incorporate those forward-looking indicators of the market risk premium and shift from that baseline of 7.95% to come up with a timely estimate of the market risk premium. And I've just done that analysis last week for a client that was very interested in that particular computation. Finally, how much estimation is there in these approaches? These computations are not for assessment. This is just a concept that is for assessment. So how much estimation error based upon these two approaches? As I say, these computations are not for assessment. I just want to give you an idea about estimation error. So here's how I did the computation. I said, suppose that I take an estimate of the standard error of an average from these two samples. Now, what's the difference between a standard error and a standard deviation? You might have encountered this in your statistics classes. A standard deviation is a measurement of dispersion in a sample. A standard error in a sample is a measurement of estimation error in an average. And you might have learned that a t-statistic from your statistics class is the difference between an average minus an hypothesized level of that variable divided by the standard error. Not the standard deviation, the standard error. So a t-statistic is the number of standard errors away that an average is from some hypothesized level. In a sample of data in which each observation has equal weight, the standard error is going to be the standard deviation divided by the square root of the number of observations. Well, in this particular instance, if we take the you can estimate a range, like a margin for error, by taking the standard error, standard deviation divided by the square root of the number of observations. And then you can say, well, how many standard deviations away from the average would you need to have a 75% chance of occurrence? Recall from our discussion of the normal distribution that we had earlier that 68% of observations typically lie within one standard deviation from the mean. Well, in a sample, roughly 1.15 standard errors away from the average gives you a 75% range. And based upon the variation of market returns in the historical time series, I did an estimate of the standard error of the market risk premium using both approaches. And I took the average plus or minus 1.15 standard errors to give me this range. You don't have to repeat these computations. This is for your information to show how much estimation error there is in the market risk premium. Using approach 1, we could say there's a 75% chance that the market risk premium, based upon analysing just 40 years of data, could be anywhere from 3.5% to 9.7%. Under approach 2, we could say that there's a 75% chance that the market risk premium lies anywhere from 6.2% to 12.5%. And if we take an average from these two approaches, there's a 75% chance that the market risk premium lies somewhere from 4.8% to 11.1%. Or in aggregate, if you only analyse 40 years of time series data, you could form a view that the market risk premium could lie anywhere from 5 to 11%. There's a wide margin for error because share prices are highly volatile. What would I recommend you actually use in practice? I recommend you use this estimation technique exactly the way that I've described here, and I recommend that you apply a margin for error around that estimate of around about 1 to 1.5% either side. So if you're doing this computation today, you might say, well, the market risk premium is estimated at, for example, 7% on average, but a margin for error around that would give me a range of somewhere from 5.5% to 8.5%, or you could narrow it to 6% to 8%. If you have too wide a range, you can't reach conclusions really on anything. So, my friends, that is the conclusions on estimation. We've estimated beta, risk-free rate, and market risk premium. In the next and final video in the capital asset pricing model, I'll talk about uses and limitations, and I look forward to that discussion.